Welcome to Age, Pension, Super and Retirement. I'm your host Yvonne, and as always, this podcast is information only and not personal advice. Today we are looking at part 2 of the intergenerational wealth transfer, and I would like to welcome back the Director of Prosperity Planning Partners, Gayle McKew.
Good to be here. Thanks for having me.
Oh, my absolute pleasure. Gayle, could we talk a little bit about the tax impact on inheriting the family home?
So let's think about this. The family home may or may not have been used to create and generate income. If it's been used to generate income, there can be some tax implications for anyone, even if it's the sale of your family home and you've had, say, a home office or you've run your business out of it and you've claimed parts on your tax of your property usage, then that can create a CGT impact. But for the majority of people who've never had a business that they run from home, the family home has up to 2 years from date of death to be transferred without impacting, and that includes sale. So when I say transferred, it's got to go into the name of the executors so that it can be sold, or potentially into the name of the beneficiaries after it's been in the name of the executors. It's a bit of fluffing around, but that's the way the system works. If there has been no income generated from that property, effectively you can consider the property will be an exempt asset for up to 2 years from date of death. Anything past 2 years after date of death, if there's a very complex estate or there's a dispute, that will then turn it into a capital gains tax asset.
Fantastic, Gayle. Now, I want to ask about assets that were bought prior to a certain date in regards to not being eligible for any capital gains tax. Could you clear up that one?
So capital gains tax has been around since the 80s, and I believe it started in 1984 or 85. Let me just check that. 1985. So 20th of September 1985 is the magic date for capital gains tax. If assets were purchased pre that date, they're considered to be pre-capital gains tax assets. So they're effectively quarantined as being exempt up to date of death. Date of death then would create a cost base. So everything is revalued effectively as at that date of death if it's a pre-CGT asset.
So the cost base, can you just say a little bit more about, so is it a new cost base? Is that what you mean? Or?
Well, it's establishing the cost base. For example, if you had company shares in company X, let's call it that, and your parents or whoever had bequeathed those assets, owned those assets prior to death, they had actually only paid, say, $6 for a share. And at the date of death, the share was worth $150, then $150 becomes the cost base.
Excellent. Thanks so much for clearing that up, Gayle. What effect does a change of title have, for example, if inheriting a principal place of residence?
Tell me what you mean by that. Because a change of title, it basically, before I go, I'll get you to answer and expand on it, but the property's owned by person A, like the person who's just died.
Yes.
You have to have a grant of probate to be able to transfer it into the name of the executors, and then the executors have the right to do whatever they need to do with it, whether it be sell it or transfer it on. So a change of title has to go originally into the name of the executors, and then it goes to whoever the ultimate beneficiary is going to be if the property is being retained, or it will be allowing them to sell the property to distribute the estate. Does that actually answer your question?
Sure. So it goes to someone in a compulsory way, and then after that, whatever they decide to do with it, I guess.
Whatever the will says they have to do to it.
Okay. Okay. And so are there any sort of tax implications or anything like that depending upon who ends up with it, or does that depend on
That's
what?
that 2 years within date of death and whether it's never had any income generated from it. If, for example, somebody has rented their house for up to 5 years and they've never bought another one and then they move back into it, the property would still be considered to be their principal place of residence. So you can rent it for a part of the time, but the bit that I'm more concerned about in this particular example is if the tax office has ever given you a tax deduction in relation to your home office or running a business from home, because that then creates a capital gains tax impact for that portion of your home.
Interesting.
And that can create a tax impact.
Fantastic. Now, I'm curious how the GrannyFllat arrangement, how that could play into inheritance.
Well, I often had conversations with people about this. So it depends on the size of the estate and even to a point whether there's a bit of estate equalisation going on as in pre-planned in a will, saying that, mum has given child one who's going to allow her the right to live at her property, say $300,000. If there's only $300,000 in the estate, it basically stops everyone else from getting anything because mum doesn't own that granny flat. She has the right to live there. So the first child in that family would be the person who took the biggest advantage of that because they've had $300,000 paid to them for a granny flat arrangement, but any other siblings will have missed out.
So in effect, other children could be disinherited.
Accidentally, it could have as what I often refer to as an unintended consequence.
Is there any redress there for that situation?
Well, generally, no, because in most instances there is a legitimate contract executed, if it's done well and properly, between the landowner, say the daughter number one, and mum. And basically it gives them the right to live there or in future houses, whichever houses they might need to purchase. So if let's say a family decided to downsize from being on 5 acres to something that's in town, and that would still give them the right to move with the family. A formal granny flat arrangement, but if without any formal documentation, it basically puts all of the cards in the winning cards in the hand of the landowner.
Yes, that's really helpful, Gayle. When it comes to a financial amount for the right to live there, is there a general guide or a calculator, or is it just like a...
No, it's not, because it depends on the assets of the person, and also in some instances, if something's purpose-built for them on a bit of acreage. Because I've got a man I helped not long ago, his son and his son's wife have an acreage. They have a formal arrangement that basically protects the gentleman that I helped to make sure that the building costs that he put in, because they're building it, it's not just something that's like dropped in, because sometimes you can have a prefabricated thing, but in this instance, they're building it because they have to connect it to the existing dwelling for it to be legal.
That's interesting, Gayle. Now, this next one sounds a little bit complicated just before I read it, but I think it's in your wheelhouse. How could the granny flat arrangement affect aged care?
Oh, you must have been in my office yesterday when I was having a conversation with somebody about just this thing. Firstly, when it comes to a granny flat arrangement, Centrelink are automatically suspect that it's potentially being done to avoid, or as in minimise assets, and potentially to avoid having to pay a RAD moving forward. So ideally, if you're going to be entering a granny flat arrangement, you should have your GP prove and confirm that the person who is, as in the elderly parent, is going to be able to live there on their own independently. Because if they can't, say they're on, say, a level 3 or a level 4 care package, that means that they're already in need of support. So if we are in that position, then there's a much higher risk of the elderly person having a change in health and potentially needing to move to aged care. So it's really important, if you're going to go and do one of these things, to make sure that it's not able to ever be considered to be contrived by including the doctor in it.
That's really helpful, Gayle. So the doctor needs to assess beforehand.
Yes, that the person is capable of living alone and independently. Because if they're not, then Centrelink can go, oh, we think the books were cooked on this one. We're going to actually claw that amount back and include it as a deprived asset.
How interesting, Gayle. So just generally, what problems have you seen that could be avoided if families had discussions?
Oh, my goodness, lots. There's so many things. Firstly, if there's known loans between siblings, the siblings know about loans that one brother or one sister has had from mum or dad, or somebody's given them money to help them buy a house, those types of things. If there's not some form of provision for that or formal documentation that supports that, then it can actually cause quite a rift, because people will go, oh, such and such, he got more money and now he's going to get a share of mum or dad's will.
Yeah, that's such a fair point. Now, Gayle, could you talk about skipping generations? Say if someone did not wish to impact their age pension and prefer things go directly to their own children.
Now, I've had clients in the past who have been in their 70s and inherited $750,000. With what they've had, it's put them over the asset test as a couple. So therefore, by the time you add the $750,000 plus what they had, they lost their pension. So it means that they were in a position where if their parent had actually elected to maybe not give them all of it, give them some of it, or even skip a generation, you can do that, because you don't necessarily have to give something to your children if they're in agreement with it skipping a generation. Because if it's going to impact their age pension or push up age care fees, sometimes it's really not advantageous to give it to your immediate next down generation.
Yes, because as inconvenient as it might be, I guess what you're saying is it's good to plan around, because you can't sort of refuse it.
Well, and the thing is, if it lands in your bank account and you give it to your kids yourself, then Centrelink can go and look at that and go, it's a deprived asset for 5 years from the date of death.
Yes.
Thank you very much. We're just going to count it as that.
So just to drum this in, if someone didn't know they were going to get an inheritance and didn't want one, basically if they have an inheritance, there's nothing they can really do about it. Obviously they can choose to keep it or not, but there's no getting out of getting an inheritance.
Not really, no.
That's so interesting. Gayle, before we go to the last question on this episode, how could you be reached?
You can call me on 0407 159 298 or email me at Gayle, Gayle, at prosperityplanning.com.au.
Fantastic, Gayle. Could you explain insurance bonds and how they may go to beneficiaries?
Absolutely. Now, an insurance bond does not automatically form part of an estate. So that's a very key part of the conversation that we're just about to have. The reason I say that is each insurance bond has the opportunity to either go to nominated beneficiaries on the death of the life insured. So the life insured could be grandma, grandpa, mum, dad, whoever, but there's a list of nominated beneficiaries. Now, we have to bear in mind here that nominating beneficiaries can only be done if the person is of sound mind. So it can't be done under a power of attorney, because that would effectively be defeating a will. So it would have to be done while somebody is capable of making that decision themselves. And instead of having to go through an estate, it goes direct to the nominated beneficiaries once a death certificate for the life insured has been received. So it doesn't go through probate at all.
Very interesting. That is a whole big area on its own. And now this has been, as always, information only and not personal advice. For our international listeners wishing to join our Facebook group, the code word is orange. Thank you so very much, Gayle.
You're very welcome.